Welcome to our latest Meet the Manager webinar, where we have David Gallagher, who's the head of Australian fixed income at Artesian. My name is Mark Holtham. I'm a director and financial planner here at Ethical Investing New Zealand. And we're fortunate enough to have David come join us today. And the Artesian Green and Sustainable Bond Fund forms part of our SustainablePLUS series. And it's the first global bond fund that we've actually had as part of these Meet the Manager series. So we're very fortunate to have David join us today. So just a little bit about David. David's got quite high credentials, so a lot to go through here. So as well as being the head of the Australian fixed income, David is also a portfolio manager of the Artesian Corporate Bond Fund, as well as the Artesian Green and Sustainable Bond Fund. He has 20 plus years of global investment banking experience, having spent nearly 9 years in London working for global investment banks. And David is now enjoying his time back in Sydney, Australia, and has an extensive experience, risk and portfolio management and trading experience. His previous roles with RBS, and managed a credit portfolio with outright risk management of 1 to 2.5 billion. So clearly large amounts of money that he's been managing. And David has a Master of Applied Finance from Kaplan, which is formerly the Securities Institute of Australia. And while studying at the Securities Institute of Australia, David was awarded with the Macquarie Bank Dux Award for being the top graduating student. So as you can hear, comes with some high credentials. And so we're very fortunate to have David join us. So welcome, David, to our Meet the Manager webinar this morning.
Thanks, Mark. Thanks for having me today.
That's okay. So David, just before we go into the detail about the fund itself and your approach to investing, Artesian's kind of relatively new fund manager that we've introduced within our Sustainable series. Could you just provide a bit of an overview of Artesian and the team that sort of forms part of the company?
Yeah, sure, Mark. So Artesian's been around for just over 20 years now. So they started in 2004. There's around 40 of us. We've got offices in Adelaide, Sydney, Melbourne, Singapore, Shanghai, London, and New York. And essentially our business is divided into two main asset classes, and that being fixed income, such as the Green Bond Fund we're discussing today, and then also venture capital. What's a really sort of common theme, though, throughout all our fund offerings is that there is an impact or an ESG overlay that we incorporate into our strategy. So the most recent fixed income fund that we launched was a green bond ETF on the NASDAQ. And then on the VC side, we also launched recently a female leaders fund, which invests only in female founders. We've also got clean tech funds and those sorts of things. So impact and ESG is core to what we do. And it's throughout the entire organization. It's not just in this fund that we're discussing today.
Cool, that's great. So it's quite a range of offering you've got there really as well. And so good to see that there's a bit more on the impact as well, which is clearly something that we're starting to see more interest in and more offerings, which is just great to see. So just in terms of what we've had within our portfolios, we've always found it quite easy to find and locate good ethical global share funds. And quite a number have launched in the last few years. It seems like there's constant flow of new ones coming onto the market. But there's been a lot less options or availability of green bond funds. And obviously you've had yours going for a few years, but what sort of led Artesian to kind of launch that green and sustainable bond fund a few years ago?
Yeah, so that's a good question. So we were running a strategy, our corporate bond fund, which launched in 2017, and we were quite early adopters of ESG. And we did notice that some of our clients, let's call them out, say our darker green clients, were looking for a strategy that only invested in really high impact projects. So whilst our corporate bond fund did have an ESG overlay, we thought that we could design a fund that was darker green, if you like. So we launched the Green and Sustainable Bond Fund in 2020, and the fund only invests in either green, social, or sustainable bonds. And that way we're really driving the impact through those securities that we can purchase, which basically means that you can get a fixed income type return, but you're also getting a lot more impact than you would say an ordinary bond.
Cool. Excellent. And so with that, obviously that means that you've got quite strong criteria around what sort of companies make up part of the portfolio. So a number of sort of exclusions or maybe some engagement with companies to try and see whether they can sort of create some positive change to allow you to incorporate within your fund. There are a few sort of individuals out there that would sort of question when you're limiting the number of companies that you've got in your universe, that would have some impact on the returns that you would get from the bond fund. So what would what would you sort of say to people that have those comments, and how would sort of the funds for that you've got, the Artesian Green Sustainable Fund, stack up against other bond funds?
Yeah, it's a good question as well. So, we one of the things that I love the most about green bonds is that you can. I know what I'll try and do is just share my screen with you. Can you see my screen now?
Yeah, it's just come up now. Thanks, David.
Okay. One of the things that we really love about green bonds, green sustainable and social bonds, is that you can essentially get issuance from any sector of the market. So whilst you could say that potentially in some equity funds, in ethical equity funds, it might have a big tilt towards healthcare or say utilities or renewable energy providers. In green bonds, you can basically get issuance from any sector, because you could argue that any sector could carve out, or any issuer within a sector could carve out a piece of their business that they would deem to be sustainable, as long as it sort of is aligned with the principles underlying the structure of the bond they want to issue. So as you can see here, there's sustainability bonds from supermarkets and telcos, and there's green bonds from utilities and banks and real estate companies, sustainable bonds from universities and banks and the like. So really, you can get a really broad exposure through green, sustainable and social bonds to almost every sector. Obviously, as you touched on, we do have screens, so we don't invest in tobacco, alcohol, ammunition, fossil fuels, palm oil, and those sorts of things. But that doesn't cause any, in our investable universe, it's really only taking out, in the Aussie dollar market, probably half a dozen names, which doesn't, we believe, defer us from, creating better than market returns, which is what we've done since inception.
Cool. And do you have anything that sort of shows how the sort of fund has sort of performed, compared to other sort of managers, or how it's performed since it sort of started?
Yeah, sure. So this is the fund. So just for your listeners, just a little bit of background information. So the underlying fund, which is the Aussie Dollar Fund, which launched in 2020, it's got a longer track record. It's nearly up to 5 years, but you can see here it's got a 4-year track record, and it's been outperforming its benchmark since inception. So 1 year, its outperformance is 73 basis points, 2 years, 97, and since inception, it's outperformed by 121 basis points a year. And that 1 year return number's just over 7%, you can see on this line here. The underlying fund, sorry, the New Zealand dollar pie, which launched in 2023, so it's now got a 2-year track record, and it's highlighted in green here. You can see it's also its 1 year return is up around that sort of 7%. And it's also outperforming versus its benchmark, which you can see here as well. Versus our peers in the market, there's some peers that we have analysis on since our inception, which are all on this chart. So these are a lot of the other funds that we talk about, or we get asked about when we're talking to investors in New Zealand. And there's different strategies, different ways that they do things, and all those sorts of things. But our performance has been better than most of our peer group since we started, which is encouraging.
Cool. So that shows really that you can still. I mean, of course, you can't guarantee what performance is going to be like going forward, but there's always been that sort of misconception by certain individuals about the sacrifice you will make by taking this sort of approach. So it's good to have further evidence that actually it's not always, not the case really, that people's perceptions may seem. So thank you for sharing that, David. And just one question on that as well. The one thing that I quite often talk to with fund managers is that, you think about the finance industry and what impact we can have to try and create a more positive change, whether it's environmental or social, or the governance of each business. What part do you think sort of banks can play around financing that sort of change and encouraging companies to take a different approach? Do you think, is that making it easier to have banks as part of your makeup of the portfolio because they're taking a better approach than maybe what they've done in the past?
Yeah, it's a really topical point that we discuss a lot internally. So when we're looking at the banking sector, what we're looking for is leaders, not laggards. So what I mean by that is with regards to their ESG profile. So a leader that comes to mind would be Bank Australia. Really strict lending policies to the fossil fuel industry and other industries like that. They've got a really good company sustainability objectives and all those sorts of things. Then there's other banks that may have some legacy fossil fuel loans that they're rolling down, but they've set a date on when they actually roll off, and they're not going to write any new loans to those industries. So we'd also look to engage with those companies as well. But one of the other things that we sort of consider with banks is that they do play a really important role in actually driving sustainability outcomes within their clients. So a lot of the corporate issuers on this page, on this engagement page here, they go to the banks and say, "Oh, we're thinking about issuing a bond." And that's when the banks can really step in and say, "Oh, have you considered issuing a green bond or a sustainable bond?" And they may say, "Oh, no, we haven't, but what's that about?" And they could say, "Well, do you have a sustainability goals and outcomes that you may want to put into a bond structure? And if you do, you could open yourself up to more investors and a bigger bid for your bonds in the primary market." So it does actually bring in some additional benefits for the issuer. So having the banks involved in those conversations and really sort of guiding the corporates towards a more sustainable business, we think is really, really key. So yeah, the banks do play a critical role in not only the green and sustainable bond market, but the transition, we believe.
Yeah, it's great to see that. Obviously, there's a part of education there as well about what does that mean and what benefits can it provide them as well, and and the issuance and the attractiveness of that issuance that they're supporting. So just around engagement, because it's quite a sort of interesting area as well, because you've got a number of funds out there that will take a more sort of passive approach and having exclusions, rather than trying to sort of engage positively with companies to try and create a positive change. So how do you sort of ensure that the at Artesian, the ESG engagement is fully sort of integrated across all sort of investment decision making? And I know you've got the specific funds, like we've got the Green Sustainable Bond Fund, but across your other funds as well. So how do you ensure you've got actually consistency across that ESG overlay within the business?
Yeah, so it's obviously tricky running different strategies, different asset classes, different geographies, and all those sorts of things. Although we've got an ESG committee that meets quarterly, we've got a head of ESG that oversees all of those strategies. So for us, we just need to make sure that we're adhering to to what our policy outlines and what we say we do within those underlying funds. I mean, on the engagement side, we take a three-pillar approach to the corporates who we talk to, and that first pillar is really about sort of driving new green bond issuance. So a lot of the companies on this slide here, we would have taken ideas to around issuing a green bond. A local example would have been Auckland Airport. They're doing a big capex spend on the airport, and we said to them, "Well, are you using sustainable products? Are you going to be putting in any solar panels, or are you going to be using any electric vehicles, and all these sorts of things?" And they said, "Yeah, we are." So we're sort of taking ideas to corporate issuers around how they could then issue a bond off the back of that capex, which gives us an opportunity to invest in that if it all stacks up. but it also sort of grows the market, which is what we're trying to do. So that's our first sort of pillar of engagement. The second one is that we engage with companies that we have existing risk with. So obviously there's, 50, 60 odd names in the portfolio, and we're making sure we're staying on top of those. So that's usually annual engagement with them just to check in and make sure that everything's going as we think it should. And then lastly is any sort of idiosyncratic risk. So let's just say we come into work on Monday and one of the companies that we own is in the newspaper for the wrong reason, then we'd want to sort of reach out and understand what's going on and what risks lie with that particular company. So it's a three-pillar approach that we take through the engagement that we do with all these companies.
Right, and so I mean, it's great to hear, like that story with Auckland Airport, and actually just trying to get a bit of understanding about what is their approach when they're looking to sort of expand and how they're going to approach that. And is that all done sort of in-house, David, or do you sort of use third-party providers as well to assist you with that sort of engagement with these companies?
No, we do it all internally. It's a lot of work actually. So if you think about a meeting with a company, and we did 49 last year, so let's just say one a week. It's probably at least an hour or two prep, and there's a couple of analysts and myself on those calls, and then then there's the post. The report gets written up. We send it to the company who we've met with for any inconsistencies and our takeaways, and then it goes into our engagement summary. So it's all internally what we do. And we also produce an annual engagement report which highlights all the meetings that we've had that make up those sort of 49.
Cool, and that's a good sort of segue as well, because I know you talked about Auckland Airport and obviously some positive response that you got as a result of those discussions. And this probably is within your engagement report. But have you got an example of maybe a company that you've kind of taken a very proactive approach through your engagement or a meeting to try and promote a positive change that actually, off the back of that, meant a different approach that they took, which really assisted to reinforce having that company within your portfolio?
Yeah, so one good example would be NBN. So we noticed about 2-3 years ago that there was no telco issuance in Aussie dollars in the green format. So we had green bonds in banks and universities and utilities, but there was nothing in the telecommunications sector. We noticed also offshore there was a large US telco company called Verizon, and they were issuing a lot of green bonds. And then the money that they were receiving off those green bonds, they were then going out and entering into power purchasing agreements with energy companies. And what they would do is that with renewable energy companies would give them locked in cash flows for say 10 years. So then they could go out and build new green assets, new wind farms, new solar panels, etc. So we thought that was really cool structure, because not only are you getting green bond issuance, you're then also getting these new green assets built. So we took that idea to Telstra, Optus, NBN. NBN were keen to engage and learn more about it. We also took some of our sort of large investors to give them another perspective. And long story short, NBN said, we quite like the idea, leave it with us. We'll come back in a few months and we'll work on our sustainability green bond documents. They came back about 3 months later. We went through them and they asked for feedback, and we gave them feedback. And then they said, well, our goal is to issue a green bond in the next 6 months. They actually issued a green bond around 4 months later. And within that green bond, they also had those power purchasing agreements that we took to them originally. And NBN is now the largest green bond issuer in Aussie dollars. They've got billions of dollars of issuance out there. So, that's a story where we saw real change. And then what that also does is it allows us to take that to other telcos or other sectors and just sort of say, this is how it worked with this particular issuer. Could you see that also working for you guys?
Yeah, so just a couple of questions off the back of that then. So, when you presented those ideas to those sort of few telcos, were you quite surprised at how much they took that on board and how quickly they provide that issue? Because that's quite quick to sort of have that turnaround. And is that a nice surprise to have?
Yeah, it is, and that's a successful story. I've got plenty that weren't successful. So sometimes we get have three meetings with issuers, and it gets right down to till we think they're going to issue a bond, and then instead of issuing a bond, they might do like a sustainability linked loan or something, which means that we don't get to participate. Or the treasurer just says, no, we're not. We're just going to issue in regular format, not in a
Mm.
labelled format. So yeah, they're not all as good as that story. But yeah, I think it was a lot quicker than we thought.
Yeah.
Considering a very large organisation and lots of gatekeepers and key stakeholders and decision makers. So no, we were really pleased with that outcome.
And I guess that the second sort of question on that is that because of that success that they had and the quick turnaround, and you're then going to other telcos to say, well, look what they've done. Do you think that sort of adds that extra pressure to them to go, well, actually there is the demand there and it is possible. So it should be something that we'll be looking at going forward rather than actually just turning a blind eye to it and think it's not relevant.
Yeah, exactly. Because if you think about how successful their deals have gone too in secondary markets, it kind of gives a bit of a platform for other issuers, telcos, and otherwise to go, that was such a successful deal. We should also consider these things. And if you think about most corporates have got sustainability goals and ESG goals and objectives, and so what we're essentially saying to them, is if you can incorporate those into a bond structure, communicate to the market about what you're doing and why you're trying to achieve those things, it can really bring that sort of brand value along as well, which could be, really important for their employees, for their
Mm.
shareholders, for the culture of the business. It's not about just issuing a bond. It's just that sort of, the alignment throughout the entire organisation can also just be another value add.
Mm. Yeah, no, that's great to hear. And just from Artesian's point of view, and obviously, you're there to manage these sort of assets and in a way that's sort of protecting investors' capital, but also and sort of providing those returns. But is there some kind of measure that the business has around how successful you are when it comes to this sort of engagement and your ethical criteria when it comes to choosing the funds? Do you try and target maybe so many each year that you can get positive engagement and positive change, or is it really just about making sure that you're having those discussions and then hopefully off the back of it you can create change, or is there a certain target that you've got to try and make change?
Yeah, we have usually got various targets. We don't have any sort of like, recurring targets of, let's have X amount of meetings and let's have X amount of what have you. But each year we set new targets. So this year, which is also in our engagement report, we're really focused on trying to get a blue bond issued in Aussie dollars. And we've had quite a few meetings, and that's ongoing. But that really is a key objective and goal of ours, is to try and get a blue bond. And essentially, a blue bond, the use of proceeds go into looking after water and oceans and marine life and all those sorts of things. And considering, where we live on a big island, basically, we think that could be really attractive to investors and certainly attractive to our fund. So that's the key goal this year. And then another key goal is to expand on the metrics that we report on. So as you're aware, Mark, but maybe your listeners aren't, we extract the impact out of the bonds that we buy. So let's just say we buy a social bond and that educates 100 women in Southeast Asia, and we own 1% of the bond. Well, we've educated one woman. Then that impact then goes into our impact tool. So what we're trying to, another goal this year, through engagement, through understanding corporates and what they can report on and all those sorts of things, we want to expand those metrics. But then if we have this discussion next year, we'll have a different set of objectives. So it's not really a recurring set of goals that we have with regards to engagement. It really is just trying to, as we achieve certain things, we just try and move forward and push boundaries and all those sorts of things.
Well, interesting to hear about the blue bond as well. So, because there's definitely a lot more folks, and certainly part of the groups that I'm with, talking around biodiversity and nature and how important that is really in sort of our whole society really. So I think, yeah, that's definitely something that's getting more focus, and I definitely feel there'll be a good demand for that. So that's good to hear where it sort of could lead in the future.
Yeah. Yeah. One of
And
the issues that we're having is that some corporates may have some exposure, like Brisbane Airport. They've got some mangroves that they're planting, which, sequester
mm,
carbon and all those sorts of things. But when you look at these sort of projects in isolation, they can be sort of $1, 2, 3, $4 million. So really what we need is for it to be a liquid deal that we can invest in the market. We need a bigger deal. So we think we're going to have to sort of lean on government or semi-government or state
mm,
governments to get the sort of size transaction. And generally, we wouldn't invest in a bond less than 100 million. So to try and find an issuer who has spent $100 million or more on blue projects is quite
mm,
tricky.
yeah.
Although we're actually talking some water utilities and also trying that avenue. So yeah, watch this space. Hopefully we manage to get something done.
That's good though. It's good. At least you're trying anyway. So that's great. Just one last question around sort of engagement is that, and I've had this conversation with a number of managers that, let's say that something comes out to market, and maybe there's some issue that's presented around a company that you've already invested in, and then you start having that engagement to understand, well, what's going on, and what's sort of your approach to this sort of issue. And they then say, yep, this is what we're going to be doing. We're going to try and resolve it by this way. And then maybe in 6 months, a year's time, you go back and see them again, but then it's not necessarily resolved. Like, is there a certain point where you say, right, well, enough is enough now, like we've given you enough opportunity
Yeah.
to make this change. We're now gonna withdraw from the investment.
Yeah. Yeah, so we definitely do that. We don't we wouldn't give them that sort of long either. So our approach would be if we now understand that there's a risk in the business that we don't think aligns with what we're trying to achieve in the fund, uh, we generally would reach out to them. It'd be quite rare that we would just back off something that we read in the newspaper. Um, so we would reach out to the issuer and say, we just want to understand whether this is the case. If it is the case, what's the plan around this? How did this come about? How are you going to manage this risk going forward? All these sorts of things. And to your point, we would then want to see a really detailed plan around that. Now, it can vary. Some businesses won't really give you a lot of color on what they're going to do or how they're going to deal with it. And you can see they're just being defensive and those sorts of things. Whereas others will say, oh, actually, yeah, this is what's happened. There's obviously an error, or it wasn't something we're aware of. So we've put all these procedures in place to try and make sure this doesn't happen again. So the feedback that we can get can vary, but if it's not up to standard, then we would sell the security.
Mm,
There's lots of different bonds out in the market that we can buy.
mm,
So if there's one that is sort of failing on what we think pretty important metrics, then we would sell that security and go and buy another security. Doesn't mean that in the future we may not reinvest in that company if they manage to sort out those risks that were made aware to
mm,
us. But we generally just take the approach of, well, there's lots of other opportunities in the market, so why don't we just sell this security now, look for another opportunity, and just sort of monitor that company in the near future. What we're trying to avoid is sort of any ESG or greenwashing or anything like that. That's really critical to
yeah,
us. Um,
yeah.
so why sort of teeter on the edge with something if they're looking like they've got a little bit of a rap sheet? So we'd rather just be conservative, sell the security, and go into something else.
Cool, and that's good to hear. So I mean, yeah, it's not always been the answer that I've had before, so it's quite good to see that there is a line drawn in the sand, and it's depending on their reaction and how strong they are in terms of their response. So and I guess if it's an issue, then yeah, sometimes I've come across it with maybe supply chains where they've not realized, and then they've owned their mistake and then said, yeah, look,
Yeah,
we hadn't realised we're making a change, and so we just own up to mistakes. Sometimes they happen, and this is what we're doing to fix it and change it. Yeah, sometimes that's the best approach, especially from a PR point of view as well. That you don't try and hide behind it and become defensive. So yeah, that's good to see. And you've already touched a little bit on this, David. It's probably kind of like the final sort of question to see where the future goes, and it is really interesting to hear about this sort of blue bond, because that's the first time I've ever heard that reference. So that's something new. But aside from that, where do you see this sort of growth in green and sustainable investment, and especially around ones that can have some kind of more impact, especially from a social side of it? Because there's as I mentioned before, bigger demand for it, but sometimes with those impact, it can be quite hard to invest in those types of things because of maybe more concentration, maybe not listed companies. So where do you see this sort of developing over the next sort of 5 years, 10 years, and what sort of new and emerging do you think will take place to help with this transition that needs to happen?
Yeah, there are, as you say, Mark, there are some impact bonds that you can buy that are usually like really small, so like $10 million. And they're usually really good projects, might be social housing for people with disabilities or something like that. However, for our funds that we manage, we need all of the bonds that we purchase to be liquid, so that we offer our clients, such as yourself, daily liquidity to come and go out of the fund. So the bonds that we own, we need to be able to buy and sell on a daily basis. So we do acknowledge that there are some really high impact projects that we just won't get exposure to. However, on that specific example that I just gave you, I know that if we bought Bank Australia's bond, they've actually got loans to social housing in disabled people. So there are other ways of getting exposure to those sectors. But I think the growth of the market is really what we're seeing, in Australia anyway, is that at a government level, things are becoming a little bit more ambitious. And we're seeing that then feeds into corporates becoming a bit more ambitious. And then it's really about, investors such as ourselves and banks going out and talking to these issuers about how they can actually issue a green, sustainable or social bond, tie those projects into it, and then also, have a successful deal so that they have a good outcome for their business, and also the investors feel like they've had a good outcome too. So I think the additional labels could be really cool. I think there's orange bonds, which are gender bonds, are also really interesting, and we think that there's parts of Asia that could really improve on those gender metrics. So we're talking to them as well. Blue bonds, and then obviously just growing the existing labelled bond market. The amount of issuers that we've got, and there has been some headwinds. Certainly with regards to regulation and taxonomies and rules and all those sorts of things. But we think a lot of those sort of headwinds are now kind of behind us. There's obviously a pretty big headwind in the US, but that should pass in about 3.5 years. But for us, it doesn't really affect us. We've never really been a big investor into the US. It's not really a big green bond market for us. So Europe and Asia is really where we've always kind of invested and generated, our alpha and impact and those sorts of things. So we're seeing, considerable year-on-year growth in Europe. They continue to sort of double down on the transition and environmental and social outcomes and issues. So certainly anything that's going on in the US is not going to deter them from, their own ambitions. And we're also seeing, in Australia and New Zealand that, the green bond market's continuing to grow as well. So, yeah, we just want to see that continuation of growth, new sectors coming online with bond issuance, and all those sorts of things. So we do see the market expanding, getting bigger, which means that, there's more opportunities, for funds like ours and our investors.
Yeah, I mean, I know looking at Europe, I mean, they certainly, certain countries in Europe have really led the way when it comes to that sort of transition. And Asia as well. I mean, I've seen, all the work that's being done in China and the massive investment they've got around renewable, in particular in electric vehicles. Now, do you think sort of Australia and New Zealand can learn a lot from that, and there's a bit of catching up to do in sort of compared to sort of Europe and parts of Asia?
Yeah, I mean, definitely in Australia. I mean, New Zealand's grid, I think, is almost 100% renewable, and
Almost, yeah.
certainly not like that in Australia. So yeah, we've definitely got a bit of catching up to do, but it sounds like the right noises are getting made,
Mm,
and it sounds like that that journey has started. Australia issued their first green bonds about a year ago. So better to be late than
that's
never.
good.
Um,
Yeah,
so yeah, so we're starting to see some progress being made, and that's good. So I think the thing is that we may not have been a leader, but we're certainly sort of taking quite a cautious approach to it. And I think that you know like in the green bond that the government issued, it was very well thought out and all those
mm,
sorts of things. So I think and there certainly seems to be a big budget allocated towards the transition as well. So yeah, we just need to see how all that sort of plays out. But certainly there's a lot of learnings from Europe and
yeah,
also
yeah.
okay. They're always leaders in sustainability. So yeah, we really closely follow what's going on there.
Brilliant. Well, I'll leave it there, and I really just want to just say thank you very much, David, for giving up your valuable time. I know how busy you are, and obviously the success that the business have had and will continue to have going forward. So I appreciate the time that you've given to us today, and to also our clients to be able to hear directly from you as well. So I know they really appreciate it, and we as a team also appreciate your time, David.
No problem at all. Thanks for having me, Mark.
Thank you very much, and I'll see you again soon in New Zealand.
Right.
See
Thank
ya.
you. See ya.